Retirement sounds great until you realize that your income disappears, but your expenses don't. So the question we're tackling today is, how much do you need in index funds to make sure you never run out of money? The answer really depends on three factors. First, how much money do you plan on withdrawing each year? You've probably heard of the famous 4% rule, but does it actually hold up today? Second, what kind of retirement lifestyle do you want? Is it going to be frugal and stress-free, or is it all-out luxury? And third, when you plan on retiring, whether it's at 65 or much earlier, like in your 40s. Let's start with the foundation. How much can you withdraw each year? You might have heard people throw around the term the 4% rule as a rule of thumb for retirement withdrawals. So what is it? In plain English, the 4% rule says that if you retire with a chunk of money invested, say in a broad index fund, you can withdraw 4% of that nest egg in the first year of retirement and then the same amount adjusted for inflation each year after. The guideline emerged from a study looking at the historical market data. It was designed to make your money last for about 30 years without running out. In other words, it's a way to estimate a safe income stream in retirement without depleting your portfolio too soon. But here's where it really gets useful. If you can safely withdraw 4% of your portfolio each year, that also means that your total savings would need to be about 25 times your annual expenses. This is often called the 25x rule. To put it simply, for every $1 of yearly spending, you would need about $25 invested. If you plan to withdraw $50,000 a year in retirement, you would need roughly $1.25 million invested to support that. Similarly, a $60,000 yearly spending would require about $1.5 million invested. This gives you a quick way to estimate your retirement number at a glance. So the 4% rule and the 25x rule go hand in hand. Now, before you either breathe a sigh of relief or spit out your coffee hearing those numbers, remember, this is just a starting point. Some experts actually debate the 4% rule. The financial planner who first studied it found 4% to be the safe withdrawal rate in the worst historical scenarios, and even said that you might go up to 5% in less dire cases. On the flip side, others said that we should be a lot more conservative, like a 3% withdrawal rate to be extra safe. But generally speaking, 3 to 4% is considered a safe withdrawal rate for most retirees, historically speaking. This brings us to the next piece of the puzzle. What kind of retirement lifestyle do you want? Suppose you only need $30,000 per year to fund your frugal retirement. That might cover basic living expenses in a lower cost area. Under the 4% rule, you would need roughly 25 times $30,000 equals $750,000 invested. Yes, under a modest lifestyle, you might be able to retire comfortably with under $1 million. If you were extra cautious and wanted to use the 3% withdrawal rule instead, you would need about 33 times $30,000, which equals $990,000 or around $1 million. Not bad for a lean retirement. Now imagine that you want $50,000 per year for a more comfortable retirement. Using the 4% rule means roughly $1.25 million invested. Interestingly enough, this $50,000 per year figure is in the ballpark of what the average American retiree household spends. At a stricter 3% withdrawal rule, to get $50,000 a year, you would need about $1.67 million invested. Finally, let's talk about big spenders. Maybe you want $100,000 a year in retirement. Using the 4% rule guideline, you would need about $2.5 million invested. At a 3% withdrawal, you would be looking at around $3.3 million. In other words, a multi-million-dollar portfolio is required to sustainably spend six figures annually in retirement. The key takeaway here is that your desired lifestyle heavily influences how much you would need invested. The third piece of the puzzle is when you retire, because retiring at 65 versus 55 or even 45 can change the math significantly. The classic 4% rule was based on about a 30-year retirement horizon, like retiring at 65 and living up to 95. But what if you want to retire early, say at 55 or even 45? Financial independence / retire early or the FIRE movement enthusiasts ask this question a lot. The common advice is to dial back the withdrawal rate a bit, maybe to 3.5% or even 3% if you expect your money to last 40 to 50 plus years. In fact, updated analysis of historical data with a 100% stock portfolio suggests that with a 50-year horizon, a 4% withdrawal rate had a 90% success rate, whereas a 3.5% withdrawal rate boosted the success rate closer to 100%. This chart illustrates the point for a 50-year retirement. The vertical axis is the success rate, essentially the probability that your money lasts the entire period based on the historical market returns. The horizontal axis is the withdrawal rate. Notice how at 3% to 3.5% withdrawal, the success rate is very high, or almost near 100% in most scenarios, especially with mostly stocks in the portfolio. But as you creep up to 4% and beyond, the success probability starts to drop. The takeaway here is that if you retire very young or just want to be extra cautious, aiming for a lower withdrawal rate greatly influences your chances of never running out of money. This might mean accumulating 30 times or even 33 times your annual expenses instead of 25 times. Another consideration with early retirement is that you won't get Social Security or pension for many years. For example, retiring at 45 means that you have to wait 20 plus years to get your Social Security. That means that your investments have to carry the full load for much longer. On the other hand, if you retire at 65, Social Security might cover a chunk of your expenses. The average benefit might cover $15,000 to $30,000 per year depending on your earning record. The bottom line is, the younger you retire, the more you generally need saved up. Finally, let's put all this together. First, use the safe withdrawal rate to find your target. A common starting point, again, is the 4% rule, meaning that you need roughly 25 times your annual spending invested. If you're more conservative or planning for an extra long retirement, you should use a 3 to 3.5% withdrawal rate, which means 30 times to 33 times your annual expenses. Second, match your portfolio to your retirement lifestyle. For instance, $30,000 per year spending could be sustained by around $750,000 at 4%, whereas $100,000 per year would require about $2.5 million. Your number is personal. It's about what you plan to spend. Crunch those budget numbers to estimate your annual needs. Then apply 25x or 30x rule to see the ballpark for your investments. Third, consider your retirement age. The younger you retire, the more cautious you should be. If you're planning to retire at the traditional age of 65, well, the 4% rule was built precisely for that, for a 30-year time frame, which held up approximately 95% of the time if you look at history. If you're planning on early retirement, say 45 to 55, consider dialing it down to 3 to 3.5% withdrawals, which might mean saving a bit more before you retire just to make sure that your money lasts 40 to 50 years. And fourth, index funds are your friend. Investing in a broad index fund like the S&P 500 or a total stock market index fund has historically provided the growth needed to support these retirement withdrawals. We're talking about approximately 10% average annual return over many decades. Keep in mind that you should still maintain a balanced portfolio that matches your risk tolerance. Some retirees hold bonds or plenty of cash for stability, but index stock funds will likely remain the growth engine that keeps your nest egg producing income. I've talked a lot about bonds, asset allocation, and the bucket strategy in previous videos, but I'm not covering those here because the question was specifically about index funds. Lastly, plan, adjust, and enjoy. Whatever your number is, be it 750,000, 1.5 million, 3 million, or more. Remember, retirement planning is not a one-and-done deal. It's okay if you don't hit the bullseye exactly on day one of retirement. What's important is that you have a reasonable target and a flexible plan. Do you think the 4% rule still holds up? Let me know in the comments.